If you're like me, you want to stay sharp on the financial world, but without getting buried under just a mountain of data, right?
Yeah, absolutely. It's a lot to track.
That's exactly what we're here for. We're giving you the shortcut, diving deep into critical financial reports, pulling out the most important nuggets of knowledge.
Mm-hmm.
Today, we're taking a deep dive into Truist Financial Corporation's second quarter 2025 earnings. We're going to, peel back the layers of a major financial institution's recent performance, really try to understand what's driving their numbers.
Sounds good. There's quite a bit to unpack there.
Right. Our mission is basically to unpack the headlines, grasp the strategic moves behind them, and give you crucial insights into Truist's financial health, the kind you just won't get from a quick glance at the news.
Definitely need more than the headlines for this.
So let's begin with the big picture then.
Yeah.
How did Truist actually perform in the second quarter? What do the numbers say?
Well, okay, looking at the headline numbers. Truist reported net income available to common shareholders of $1.2 billion. And that translates to $0.90 per diluted share for Q2 2025.
90 cents a share. And revenues.
Right. So their total taxable equivalent revenues, and just, for clarity, that means adjusting for tax benefits on some income streams makes it easier to compare different investments. Those were up 1.8% from the prior quarter.
Up 1.8%.
Okay. And if you then factor out some securities losses they had, that revenue growth actually climbs a bit higher to 2.1%.
Got it. So 2.1% adjusted growth. That's a solid starting point. Now, I think you mentioned, or I saw, there were a couple of specific adjustments factored into these results. What were those?
Yeah, you're right to pick up on those. It's important context. The reported figures included about $0 on 2 cents per share in restructuring charges.
Okay.
That was mainly severance related, so it points to some internal, maybe operational adjustments happening.
Mm-hmm. Streamlining or something?
Could be. And on top of that, there was a smaller $0 or 1 cent per share loss from selling certain investment securities.
Selling securities at a loss. Why?
Well, it was an $18 million pre-tax loss on about $398 million in sales. But the interesting nuance here is they expect to earn that loss back in roughly 2 years.
Ah, so strategic move then.
Exactly. It suggests they were making portfolio adjustments, even taking a small short-term hit, probably aiming for longer-term benefits or repositioning.
That makes sense. So, okay, stepping back from the immediate numbers.
Yeah.
What's the overarching philosophy here? How does Truist see itself, guiding this performance?
Yeah, it's clear the leadership, particularly the chairman and CEO, really emphasizes their core purpose, the inspire and build better lives and communities idea.
Right. You hear that a lot. Is it just talk?
Well, they frame it as the fundamental bedrock of their strategy. It seems to genuinely guide decisions and, energize the teams. They connect their solid performance directly back to the diversity in their business model.
Okay.
And just focused execution on strategic growth initiatives.
Like what specifically?
Things like deliberately targeting new client acquisition, deepening relationships, especially in those key fee-generating areas like payments, wealth management, premier banking, and doing all that while keeping a tight rein on expenses and credit quality. Plus, they're focused on returning capital to shareholders and making these ongoing investments in talent and tech.
Talent and tech, always crucial. Okay, let's unpack one of the most vital areas for any bank, the loan portfolio. What did that tell us this quarter?
Yes, loans. Here's where it gets really interesting. It was actually an exceptionally robust quarter for lending.
Robust.
Average loans held for investment climbed 2.0% just compared to the previous quarter.
0% average growth. Okay.
And maybe even more impressively, the end-of-period loans, the snapshot right at the end of June, saw a substantial rise, up $10.2 billion.
$10 billion. Wow. That's what, 3.3% quarter over quarter?
Exactly, a significant jump.
Was this growth concentrated, like just mortgages, or was it broader? What does it signal about demand?
Well, what really stands out is that the growth was truly broad-based. It wasn't just one thing.
Okay.
It spanned both commercial and consumer segments. We saw notable increases in commercial and industrial loans, C&I, also residential mortgages, other consumer loans.
Which includes things like?
Yeah, driven by platforms like Service Finance and Sheffield They Own. And even indirect auto loans saw growth.
So pretty much everything. That suggests pretty healthy demand across their markets then.
It does. And they also mentioned their lending pipelines remain strong. And overall loan production is up significantly compared to last year. And here's a fascinating detail. They apparently attracted twice as many new corporate and commercial clients compared to the same period last year.
Twice as many. That's huge.
It is. And not only that, they're seeing a remarkable 40% increase in revenue per client from those new relationships.
Wow. Okay, so it's not just volume, it's high-value volume.
Precisely. It's about growing profitable relationships, not just the loan book itself.
So we've talked loans, the asset side. Now let's flip to the other side, deposits, the funding. What did those numbers reveal?
Right, deposits. Average deposits did show an increase, up $8.3 billion, or 2.1% sequentially.
Okay, up 2.1%. What drove that?
Primarily growth in interest-bearing checking accounts, time deposits, CDs, and also non-interest-bearing demand deposits.
That sounds positive.
Yeah.
But I remember reading there was an important nuance, something about temporary deposits being withdrawn.
Yes, you're absolutely right to highlight that. This is a really crucial detail for understanding the true deposit dynamics.
How so?
Well, those average deposit balances were impacted by about $10.9 billion of, let's call them short-term client deposits from the prior quarter that have since been withdrawn.
10.9 billion. That's a big swing factor.
It is. So if you actually exclude the impact of those temporary sort of high volatility deposits, average deposit balances would have actually been down slightly compared to the prior quarter.
Ah, okay. That paints a different picture. Shows the competition for stable deposits, maybe?
Exactly. It tells you about the intense competition for those sticky, stable deposits in today's environment.
And what about the cost? Did that short-term money affect their deposit beta?
It did. Their cumulative interest-bearing deposit beta, that measure of how sensitive their deposit rates are to market rates, it actually declined from 43% to 37% quarter over quarter.
Declined. That seems counterintuitive if temporary money left.
Well, that's the thing. Without those large, presumably higher rate short-term deposits distorting the figures, they noted the rate paid on interest-bearing deposits, and the beta would have been relatively stable.
I see. So the underlying core funding cost was more stable than the headline beta suggests.
That seems to be the message, yeah. Underlying stability.
Okay, that definitely raises an important point about managing those deposit costs and competition, especially with these temporary shifts. It sounds like Truist's focus on attracting younger, maybe higher balance clients and really deepening relationships. That seems key here, like an antidote to that volatility.
I think that's exactly right. It's a very smart play long term.
How so?
Well, the competition for deposits, especially stable, low-cost ones, is always fierce. Always. By focusing on attracting higher value clients and, really fostering those deep relationships, they're not just chasing hot money or reacting to rates.
They're building loyalty.
Essentially, yes. Building a more resilient, less volatile funding base. It's a strategic approach. Aiming for stickier deposits, less prone to sudden withdrawals, should help them navigate future rate cycles better. They also mention momentum from new bankers in corporate and commercial, and public funds coming online too.
Right, those new hires starting to produce. Okay, now let's talk about the engine, the core profitability engine for any bank. Net interest income and net interest margin, NII and NIM. How did those look?
Good performance there too. Taxable equivalent net interest income increased by $80 million. That's up 2.3% compared to the prior quarter.
80 million increase, okay. And the margin, the NIM.
Their net interest margin, NIM, basically the spread between what they earn on assets like loans and pay on funding like deposits, it actually ticked up by 1 basis point.
Just 1 basis point.
Yeah, hitting 3.02%. Now, 1 basis point might sound tiny.
But for NIM, it's significant, right? Especially if it was expected to maybe compress.
Exactly. It's definitely a positive movement. The main drivers were that strong loan growth we already talked about, the repricing of their fixed-rate assets coming through, and, believe it or not, even the small benefit of having 1 extra day in the second quarter.
The calendar effects.
Okay.
And looking ahead on that repricing.
Yeah, that's important. They have a substantial chunk of fixed-rate loans and investment securities, roughly $27 billion worth, set to reprice over the rest of 2025.
27 billion. What kind of rates are we talking about?
Well, what's compelling is they anticipate the new fixed-rate loans coming on the books will have a run-on rate around 7%, while the stuff maturing or running off has a rate around 6.4%, so that positive spread should help support NIM going forward.
A nice tailwind.
Seems like it. And one expert commentary piece mentioned that a more normalized NE, looking longer term, could be maybe closer to 3.1%. suggests some sustained profitability potential there.
Interesting. Okay, let's shift gears then. Non-interest income,
Yeah.
fee income, trading, that sort of thing. Sounds like it was a bit of a mixed bag here.
You hit the nail on the head. A mixed bag is a good description. Overall, adjusted non-interest income did increase up $25 million or 1.8% linked quarter.
Okay, so up overall, what drove the increase?
A significant piece was an $83 million jump in the other income line item.
Other income, always a bit vague. What was in there?
Yeah, it's broad. But in this case, they said it largely included higher income from NQDC plans, non-qualified deferred comp plans, often offset elsewhere by personnel costs, and also income from some solar equity and other strategic investments.
Solar equity, okay. But you said mixed bag, so there were some headwinds too,
Yeah.
particularly in market-sensitive areas.
Exactly. That positive from other income was partially offset by a pretty notable decline in investment banking and trading income. It was down $68 million, or about 25%.
25% drop. Ouch. What happened there?
Reflected weaker trading results, generally lower capital markets activity, and also reduced M&A volumes, especially early in the second quarter, like in April.
Market volatility biting them.
Seems like it. Their trading business, which supports investment banking, actually had some losses because of that market volatility in April.
But did it recover?
It did. They saw a strong rebound and improvement in May, and then what they called normalized performance in June. So that's leading to, real optimism for a second half recovery in investment banking and trading revenue.
Shows the benefit of diversification, I guess. One area picks up when another slows down.
Exactly. That diversified business model at work.
So given these revenue and income dynamics, let's talk costs. What does this all mean for managing expenses and investing in the future? How are they balancing growth and discipline?
Well, non-interest expense was up, rose $80 million, or 2.8% compared to Q1. Adjusted non-interest expense, pulling out those restructuring charges, increased 3.1%.
Okay, expenses up around 3%. Why?
The primary driver was higher personnel expenses. That reflects things like annual merit increases, but also strategic hiring efforts. So higher salaries, some post-retirement benefit expense, which, remember, gets partly offset in that other income line, and also higher incentives. They're investing in people.
It makes sense if they're hiring strategically. And those restructuring charges in Q2, just to clarify, were those related to the big merger from years ago or something new?
Good clarification. No, the $28 million in restructuring charges this quarter were not related to the historic merger integration. They specified it was for severance and repositioning of different parts of the company. It shows ongoing optimization.
Okay, ongoing tweaks. What about year over year?
Year over year, adjusted expenses were up 2.1%. They said that was due to higher professional fees and outside processing costs, largely tied to those ongoing investments in technology and risk infrastructure.
Right, the tech spend. So expenses are up, but what's the bigger picture on cost control?
The key takeaway here seems to be their confidence in hitting their full-year target of only about 1% adjusted expense growth.
Only 1% for the full year. That implies costs have to slow down or revenues really pick up.
Exactly. It implies achieving positive operating leverage, meaning revenue growth outpacing expense growth somewhere in the range of 50 to 150 basis points. They believe they can do it by balancing cost discipline with those strategic investments, some of which, like efficiency tech, might even be self-funding over time.
Balancing act.
Okay.
What stands out to you regarding their asset quality? How healthy, how resilient is that loan book looking right now? Because that's really the backbone.
Yeah, absolutely critical. And the news here was remarkably strong. Asset quality metrics remained really solid.
How solid?
Net charge-offs loans they actually had to write off as uncollectible. They decreased 9 basis points down to 0.51% compared to Q1. That's multi-quarter lows.
Wow, charge-offs going down. That's quite good.
It is. And non-performing loans and leases also decreased 9 basis points, settling at a very low 0.39% of total loans. Just really healthy levels.
And the allowance. The money's set aside for future losses.
The ALL ratio, allowance for loan and lease losses, it decreased slightly 4 basis points to 1.54%. But the provision for credit losses, the amount added to the allowance this quarter, still exceeded the actual net charge-offs by $92 million. So they're still building reserves, just at a slightly slower pace given the good performance.
That's a strong overall picture. Were there any specific areas of improvement that drove this, like problem areas getting better?
Absolutely. They benefited significantly from lower losses in both consumer loans and commercial real estate, or CRE.
CRE losses lower. That's interesting given the headlines about office space.
Right, and a particularly good sign on that front, their specific CRE office portfolio actually declined by almost $500 million during the quarter on an end-of-period basis. Reducing that exposure is definitely seen as a positive.
Yeah, de-risking the office book. Very reassuring trend. Okay, let's connect this to the bigger picture. How does their capital position look? Does it support this growth and critically shareholder returns?
Capital looks very strong. Their preliminary Common Equity Tier 1 ratio, the CET1 ratio, a key measure of core capital strength, was a robust 11.0% as of June 30th.
11%. How does that compare?
It was down slightly, about 30 basis points from the previous quarter, but that was mainly due to the strong balance sheet growth we talked about, plus share repurchases and paying dividends, all expected uses of capital.
Makes sense. Is there another way to look at CET1? Sometimes they mention AOCI impact.
Yeah, good point. Their CET1 ratio, including the impact of AOCI accumulated other comprehensive income, which reflects those unrealized gains losses on securities not hitting the income statement, that was 9.3%. Still very solid.
Okay. And on the shareholder return side, sounds like they were active with buybacks.
They certainly were. Truist repurchased $750 million in common shares during Q2.
$750 million. Wasn't there a recent target more like $500 million a quarter?
It was. They explicitly said they went above target because they opportunistically took advantage of market volatility and weakness in their share price early in the quarter.
Buying the dip in their own stock. Shrewd.
It seems that way. They plan to go back to targeting roughly $500 million in buybacks during Q3. Their dividend payout ratio for Q2 was 57%, and the total payout ratio, including buybacks, was 121%.
Wow. Over 100% payout. Shows confidence. What about stress tests? CCIR.
They got favorable CCR results. Their preliminary stress capital buffer, the SCB requirement, is set at 2.5%. That's actually down 30 basis points from last year's requirement, and it takes effect October 1st.
Lower buffer is good, means less capital tied up.
Exactly. And crucially, their current 11% CET1 ratio remains a very strong 400 basis points higher than their new regulatory minimum requirement of 7%. Which includes the base requirement plus the SCB. So a very robust capital buffer.
Okay, really well capitalized. So we've dissected Q2. What does this all mean for the rest of 2025 and beyond? What's the forward outlook Truist is giving us?
Their full year 2025 guidance is pretty clear. They expect revenue to increase somewhere between 1.5% and 2.5% for the full year.
Okay, modest growth.
Net interest income remains on track to increase 3%, but that assumes low single-digit average loan growth and, importantly, 25 basis point cuts in the Fed funds rate later this year, September and December.
Baking in rate cuts, that's a key assumption. Did that change?
It's a slight tweak from their prior guidance, yeah. Reflects how market expectations for the Fed have shifted a bit.
Got it. What about fee income and expenses for the year?
Non-interest income is expected to be relatively flat for the full year, and adjusted expenses, as we discussed, are anticipated to increase only about 1%, which again implies that positive operating leverage of 50 to 150 basis points.
And credit losses. Charge-off.
They expect net charge-offs for the full year to land somewhere between 55 and 60 basis points. Still quite manageable.
Okay, that's the full year. What about the immediate next quarter? Q3 outlook.
For Q3 specifically, they're guiding to revenue increasing approximately 2.5% to 3.5% compared to Q2.
Bit stronger than the full year pace.
Yeah, looks like it. Net interest income expected up about 2%, driven by loan growth and that fixed asset repricing. And non-interest income is forecast to see a healthier jump, maybe up about 5%.
Why the jump in non-interest?
Primarily due to that anticipated recovery in investment banking and trading income we talked about.
The rebound kicking in. And Q3 expenses.
Expected to increase about 1% compared to Q2. So continued cost discipline alongside the revenue growth.
It really sounds like they feel they have a lot of strategic momentum, especially on the digital front. That seems increasingly vital.
They absolutely do. And they highlighted that. Their digital strategy is showing very strong results. Digital account production is up 17% year over year.
Wow.
And get this, 43% of their new-to-bank clients are now joining through digital channels.
Almost half. That's a big shift.
It is. They also fully integrated their Lightstream lending products into the main digital platform, making it seamless. And usage of their digital financial management tools has apparently soared by 40%.
People are engaging digitally.
Seems so. And on the business side, treasury management revenue is up 14% year over year. They pointed to new services driving that, like offering requests for payment over the RTP network, the real-time payment network, using just an alias like a cell phone number or email. Makes things much simpler for businesses.
Yeah, those innovations matter. Which I guess brings us to the competition. This all sounds positive, but it raises the question. In a fiercely competitive market like the Southeast, how is Truist positioning itself to keep this going, maybe even accelerate? What's their competitive edge?
That's a great question. The CEO addressed it directly, acknowledged it's always been competitive down there.
For sure.
But his statement was quite bold. He said Truist has never been better competitively positioned. Strong words.
Never better. What makes them so confident?
They express strong confidence in their ability to, quote, win every day. They believe it comes down to their prowess and advice and capabilities, combining human advice with strong tech, which helps attract new clients and deepen those existing relationships.
Advice and capabilities.
Yeah. They describe their internal attitude as having a bring-it-on attitude and a champion mindset. It really suggests they believe they're mixed of strong capital, diverse services, digital innovation, and that advice model gives them a distinct advantage, even in a crowded field.
A champion mindset. Okay, well, this deep dive certainly reveals a financial institution that, despite facing some market volatility and those temporary deposit shifts we discussed, is demonstrating truly solid performance.
Yeah, the underlying picture looks pretty steady.
Driven by focused strategy, disciplined expense management, and that clear push into digital and client acquisition. So here's a final thought for you, our listener. Given Truist's confident stance on its competitive position and these tangible investments in high-growth areas, what does this detailed picture signal about the future landscape, particularly for regional banks operating in these dynamic markets?
Good question. It suggests scale, diversification, and tech investment are becoming even more critical.
Right. And how might that broader trend impact your own financial insights, or maybe even your investment decisions down the road? Something to consider. We encourage you to think about the nuances we've uncovered today, and definitely keep a keen eye on how these strategic plays continue to unfold for Truist and its peers.